Chris, when you're looking at chances to dive in, what type of pace are you starting to dive in the market to for risky debt?
Yeah, I mean, we're of the view that you should be consistently investing today. It's not a time to just sort of sit on the bench and watch and wait for the bottom. I think what we've learned from previous cycles is the markets usually bottom well before the fundamentals do. And so we're of the view that you need to start, you need to get going. And when you're looking at private credit assets, it takes a while to get invested. And so you should get going right away.
Now, what's interesting, too, is this call that you make in this letter from a private credit giant like KKR. People forget that you also trade public assets, and you said that private credit could actually see more defaults. Why is that?
Look, there's been a huge growth in private credit as a whole, and a lot of that is focused on the middle market and the lower middle market. Now, where we play in the private and corporate private credit market is in the much higher end, 150 million type EBITDA up. And what we've seen over the last 12 to 18 months is our average EBITDA is growing as the public markets are sort of shut or closed. And so what we think is there's just less maneuvers, less tools for some of those smaller businesses to access the capital markets to free up liquidity. And so we actually see increasing defaults probably in the smaller middle market businesses in the private credit than what you will see in the high yield bond market. And particularly if you look at where financing has been over the last decade, people have avoided the high yield bond market like a plague. They've gone into the syndicated loan market, they've gone into the private credit market, frankly because the high yield bond market has a lot of restrictions. It's SEC registered, it's got call protection. And so what we're seeing in the high yield bond market today is the highest quality high yield bond market we've ever seen. It's 50+% double B, and I don't think looking at historical default rates in high yield is a way to look at default rates going forward into 24 and on.
Now, how do you think about the dynamic into a potential recession? You've also made this call that you expect a mild recession going into 2024.
Look, I mean, defaults are definitely increasing. Downgrades are definitely going to increase. Do we hit a technical recession or not? I'm not sure. We are of the view that we're more of a soft landing. What the Fed has done is working, and it is slowing the economy. Even at the jobs numbers today, there's a lot of dispersion in that. There's 94% of the jobs came from government, healthcare, education, and travel and leisure. There's a lot of dispersion in the market. And so there is going to be increasing defaults. But that doesn't mean this vintage deploying into private credit, deploying into new issue today, means that those are going to default. And that's the thing. It is about this credit market. It's about being opportunistic. It's about having breadth. And it's about credit selection.
Now, something we talk to a lot of investors about is when they're looking at parts of the market that could soften, they're so worried about the consumer. Now, I know today was a good day, but at the same time, should you see the consumer weaken with how levered they are to credit card debt, for example, how do you think about entering more sensitive parts of the economy like consumer debt?
Yeah, I mean, no dissimilar to what I just talked about the corporates. There's a lot of dispersion in the consumer. We feel really constructive about the high end and the prime area of the consumer, and we're a little bit more concerned about the subprime and the lower end, and that is creeping up into sort of the lower middle end. And so as there's a lot of inflation, and we think rates are going to be higher for longer. It's a higher resting heart rate. We think labor is going to be challenged, and wage inflation is going to be there. So we are deploying into consumer. We're seeing some portfolios out of regional banks. We're buying pools of high-quality auto loans. We are constructive there, but not on the subprime. And it's more and more about dispersion in that consumer market.
To the extent that you start to either get out of some areas, given the money you've seen pour into some risk assets, including in credit, or to the extent that you avoid some areas, what does that look like?
Look, we're, like I sort of mentioned, we're leaning into credit. We think if rates are higher for longer, that means equity valuations are lower for longer. That means just from a relative value, credit looks really good relative to equities. And so we're constructive on credit, and then it's about where do you go within the credit space. We like asset-based finance and what you're seeing out of regional banks. We're seeing a lot of product coming out of that, either portfolios, high-quality portfolios we wouldn't have seen otherwise, or stepping into areas where they've retreated from lending. And one of those areas is actually real estate credit, and particularly around some of the transitional assets. So We are leaning in credit, but there's places to avoid. There's going to be a lot of dispersion, secular decliners, places and businesses that haven't been able to pass on price. We're avoiding those types of businesses.
Chris, I'm curious about that regional bank play with just about a minute left here. Do you see the prices declining enough? What's the clearing price on some of these assets that are being sold out of regional banks, and is it just CRE?
Yeah, it depends. I think what we're seeing is some really nice portfolios, high quality, where actually the price is not that much of a discount, but they're actually providing a lot of financing to make the returns work, particularly for pools of capital like ourselves. And then there's also big bid ask and big discounts on stressed assets. And those are the things that we're actually not participating in, we're actually avoiding. The time to go into stressed in our mind is a time of when fundamentals are recovering. We're in an economy right now where fundamentals are declining. And so it's about keeping it simple, but there's a lot of dispersion, there's a lot of opportunity out there. So I wouldn't get caught up into the fears of we're increasing defaults, there's a bubble in private credit, which is what I hear often, which we don't agree with. And I think there's a lot of fears that are actually stalling deployment in the market right now.